Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, March 16th, 2023. It's 11:09 Eastern Time, and I'm going to start out here with the equity markets, take a quick look at Apple, the volatility indexes, where we're at, big picture, and any other trade updates or highlights I can think of. Starting out, first and foremost, let's look at the NASDAQ. I just got a post out to you just a couple days ago, gave you a downtrend line here, and labeled three resistance levels, but then in subsequent videos I highlighted this as a big level too. That 30, what is that, 303 and a quarter right there, and we're coming up on it right now. You can see there's a big old gap right there. It was really in another gap, separate on both sides, and then it was support, support, support. You had a brief dip, support again, and then most importantly that big recent reaction high. So that is, as I said earlier, that is where I would think it's objective to add up to, but not above. And today's Thursday. I'd be very curious to see how many people are going to want to go home long into the weekend. So personally, I'm going to give my swing shorts a little room. And again, this is just the 60-minute chart. Big picture still says here's the S&P 500 on the daily chart. You look at the clean board over here, and or very clean board right here. You still have the S&P 500 coming in back testing the 200-day simple moving average right there. We broke down below it here, back tested the other day on Tuesday, got rejected. We're back there again, and we're right on that trend line as well. And you also have, I believe, the Wilshire 5000 is also back testing. The Wilshire 5000 is one of the more significant indexes, probably the best proxy, even better than the S&P 500 or the overall market, because this is you have all different market caps in there. It's a very well diversified index, and just like the S&P, it's still below the downtrend line, and back testing the primary downtrend line, or I'm sorry, below the uptrend line off the recent lows, and back testing there. Significant price resistance just above, plus the key moving averages. And then of course, it's a tale of two tapes lately. You have the NASDAQ 100. When I go to a clean board, the NASDAQ 100 is still above the what I had a BOD, or benefit of the doubt, trend line right there. That comes in and captures the highs. I have quite a few variations, I think, on this trend line. Let me look and see which ones I want to show you here. Give the most bullish scenario. Darn it, I know I had one here. I'm going to draw it for you off this high right here, the all-time high. Come in and capture the majority of candlesticks. That's the one I know I had it drawn on one of the boards. It just gives you a brief violation right there, but it captures the November high and all the other highs right there, and you can see some consolidation around it. And that one comes in with the 200 days, so that's a big level. You can see we've like the S&P, took out the 200 days, but this one back tested. So I'll give points to that, but I will also say this, that the NASDAQ 100, although it's one of my favorite trading indexes, it's a very it doesn't represent the U.S. economy. It's just it's pretty much like trading XLK, the tech ETF, because half of the stocks in here are tech. It doesn't have all broad inclusion of a lot of different sectors like the S&P 500 or the Wilshire. You're lacking financials, so that's one reason you're seeing this outperformance. Now let me show you a couple other things here. So that's glass half full. But I've said this before. I promise you that NASDAQ 100 will only go so far without the rest of the stock market going up. Just like on the way down, the tech dragged the rest of the market down with it, but the S&P was more resilient. Now we're seeing the rest of the sectors, energy, healthcare, industrials, everything that held up to this point, really. So far, the official bottom of the bear market's mid-October for all the indexes, and that's where the S&P outperformed by a pretty hefty margin, and tech led the way down. And then in the beginning of the year, right here, I stated that emphatically I thought tech would lead the way and would be the place to rally and outperform the S&P, and we certainly got that trade. And I think this is just the remnants of people trying to pick up those scraps that missed out on the big move. My take, again, it's all going to be about the financial sector. If you think it's a one and done, buy tech. Go long, buy banks. If you think that the government's really plugged all the gaps and all the cracks in the dam. Obviously, I don't. That's why I'm looking for the additional areas in the financial sector, such as the bond insurers and companies that insure. Will have an exposure to what's going on there. I'm watching credit markets closely. I'm watching junk bonds. I'm watching muni bonds. I'm even breaking it down by state. I'm watching California underperform national municipal bonds. That's a state that will be on the hook. The local and state governments will be on the hook for CalPERS shortfall. I'm talking about the California Public Employees Retirement Plan, biggest in the country, and severely underfunded. So those are the things that I'm looking for. Now we'll see. Today there's a lot of green between, or meaning in the game of golf or football, whatever. A lot of distance right now between where we're at 11:15 a.m. as I speak and the close tomorrow at 4 p.m. A lot kind of will happen. There's a lot of things going on, but let's just look at the facts. So as of now, most importantly, although this from a longer term perspective, unless the NASDAQ fails, you can't really say that that's anything but bullish. However, the NASDAQ, as I just said, is not the stock market. It's pretty much tech. And so we look at the S&P 500 and we see where that's at and where the Wilshire's at. I also mentioned recently, we've been watching the VIX, covered this one many, many times, and the VIX has these a pretty clear pattern since the bear market started of these downtrend lines. You form clear downtrend lines, you have breakouts, followed by some consolidation before these big rips up. You can't argue we didn't have a big rip up. This one was in line and actually a little probably below average on some of these other ones recently. And the $1 million question, is it over or not? Once the big rips up start, sometime they just go and they don't stop until it's over. But sometimes you do have some consolidation in the middle after the breakout, after the VIX really starts to move up. So again, this, we're kind of up there. The VIX is still elevated, which still means there's risk for markets. There's still the risk, or we're still in a volatile market. Volatility is still high. So just keep that in mind. Until you see the VIX come back down to the breakout point, like that's what it did each and every other time. That's when the corrections were over. And remember, each of these big spikes in the VIX correlated with a leg down in the market. But then I told you the other day, I'm watching, the stock market will only go so far without Apple. Apple is the big dog. It is the top component. It's the largest market cap stock out there in the market. It's the leading stock of the NASDAQ 100, also the top component of the S&P 500. So I pointed out this pretty clear pattern since the bear market started. Apple having its own VIX, AAPL. You also have these pretty clean downtrend lines, right? 1, 2, 3. And you have these spikes once the downtrend line breaks. And again, I've said this before, sometimes a problem when I find such a pretty clear pattern, that's just about the time it stops working. But you can see each and every these periods when the downtrend line broke, you had a sharp rip up. I'm going to show you in 1 second, as I've already shown you, those legs up. And you can look at the scope of the move in the Apple VIX. They correlated with the next big drop in Apple. And so far we have a breakout. We have that period of consolidation that you often get after the breakout right here, right? But Apple's been holding up, and it's up today. My money is, despite the strength of this rally, we're right at resistance right now towards the upper end of where I figured this bounce might go. This is either going to happen soon, as in Apple will start to move down probably from right where we're at, because we're at that resistance now, into tomorrow, throughout today and or tomorrow, or most certainly by next week. If not, it's probably not going to materialize. But this is where I think, despite how strong the NASDAQ is, not just today, but how strong it's been lately, the market, these talking heads keep coming on saying, buy tech, this is a banking problem. Again, I talked about that in 2008. That bear market had nothing to do with tech, but tech got hammered because the market got hammered. It was a financial problem with the banks, and of course that will spill over everything. our economy is completely dependent. This isn't 1652 anymore, or even early 1800s. This economy, the world's economy is built, especially the U.S., built around the financial system. The banks are everything. Um, that's what drives our economy. We're not a manufacturing economy anymore. All right, so let me show you the other chart just in case you missed it before. So this is that same chart, but what I've done here is I have the VIX, Apple VIX in the white candlesticks. I made them a little light gray so they wouldn't be too busy. And those are the same downtrend lines I just showed you. And then the purple is the price of Apple. That's Apple right there, purple. And so you can see here was the breakout right here, actually right here. And there's what Apple did. And that was the first drop in the bear market back in early 2022. There was our next breakout, next drop, or let me cover more accurate. The next drop was to right there. Then you had an abatement right there, Apple VIX, breakout right there, another leg down for Apple to bottom. There was your next breakout right there. That's what Apple did. Here's your next breakout right here. Apple dropped right there as the Apple VIX exploded, and this is our most recent breakout. The only thing missing is the drop in Apple. So pretty clear pattern, and I think it kind of aligns with the whole is the bear market over? Did the bear market end back in October of 2022? If you think so, then you know what? Then this pattern probably won't play out anymore. If we're still in a bear market, it will, and then this is what will tech, including Apple, will probably play catch up to the downside. And I think it will largely depend upon, did the Fed and the ECB do the trick? Did they really, at least temporarily, if they can plug those gaps and shore up consumer confidence in the banking system and the financial system, and there's no other, like I said, I'm looking elsewhere. Banks are the obvious trade right now. I'm looking at the peripheral areas in the financial system for the next shoe to drop, because from my experience, there is something. Think about it. Like they even stated that they were going to wipe out the shareholders in Silicon Valley and the other banks that they've had to shore up lately, or the other banks so far, and the stock and bond holders. Okay, what's that going to do to the pension funds and hedge funds and mutual funds that hold those stocks or the bondholders? So there's always these repercussions, and that's what I'll be looking for. But I just wanted to share this, so let's keep an eye on this. If Apple continues to rally, let me just look at the 60-minute chart. Oh, here's the 60-minute of the Apple VIX right here, and I have this marked up. These are clear little wedges right here, right? Little downtrend line, breakout, and see that period of consolidation right there? Look how long it lasted. It lasted for about a couple weeks there, maybe, if that. Same thing, broke out here. It wasn't a straight rocket up. We went back and forth a little, and then the big move. And this, so far, and it could even carry into next week if you look at how long it lasted back here. And let me just overlay Apple and show you what it did at this point. At a chart properties, go to comparison, check Apple. It's colored up different colors so we can see it well. Okay, I'm going to measure it out. The scaling, when I do this, no, the scaling is going to measure out the move in the VIX. But you can see the drop in Apple right there. That was a significant drop in Apple right there. There was your next breakout was right here. There was a significant drop in Apple. And here's a breakout, zero drop in Apple. So again, either this pans out or not. To me, I think it's worth it and given a little bit of room right now. I think there's just that little bit of giddiness going on right now that tech is almost being viewed as a safe harbor. Bonds were the other day. We gamed that. I mentioned shorting bonds today. I should do an update there on that trade. That just a quick pullback trade, but I also said you can let it run if you're inclined, if you're trading either bond futures. If you trade Treasury bond ETFs, you got to use a lot of it, because bonds, if you're a bond trader, I don't need to tell you this. Bond traders, bonds are priced in pips. There's all the interest rate moves and forex and bonds. They're small moves. I'm sorry, pips are forex. It's very out to the fourth decimal. And bonds, if you get a 1% move in treasuries, that's a big move for bond traders, especially in a single day. So far, we're good for about 0.75% on that, and my pullback target's going to be about a 1% or better drop. I made a clarification in that post I gave you. It was I referred to it as a 60-minute chart. I actually gave it to you as a 120. I corrected that in the post. These are 2 hour. That's the chart I gave you. So we shorted right there. To me, that was a no-brainer short. I'll take these all day long. Downtrend line plus nice price resistance. And already, like I said, 0.75% reversal probably come in there. Nice support right there, about that 114.211. But what I started out here was that 15-minute chart. Kind of show you there's more of a support zone. If you want to cover early, you'd still be good for a good 1% to get to that 114.285. Or, like I said, if you got it. And once you get profitable, either set your stop at break even or periodically trail it down. You can use an automatic trailing stop. I like to manually ratchet my stops down and then hold out for potentially the prize. I mean, this is a big, as I showed you on that other chart, on the 2-hour chart and the 60-minute, you have big negative divergence right there. So the divergence says that we'll probably go on, we'll get the typical reaction here off this level. But you have a wedge forming here, and that wedge will probably break down after the usual reaction here when the buyers step in. All right, so that is one of many trade ideas. What else are we looking at? Oh yeah, we should talk about the euro. I threw that one out there and actually paused the video while I was doing it to buy this one. I told you I keep getting the trend line drift. I corrected it there. You see how that trend line creeps every day? Put it right back where it was. So mentioned that it's just a bounce trade, and that's about where I had the arrow, and that's exactly where I told you this morning. Closed it out because I was just looking for a bounce trade, reflexive bounce off price and trend line support. And remember what I said yesterday. I've had a whether you want to call it a soft or a hard pivot on my outlook for gold and silver based on my outlook for the euro, because there's that strong correlation between the stock market and the euro as well as the stock market and gold. One or the other is going to happen most likely. Euro is going to take another leg down, and I'll tell you, this is probably maybe a tell. I always say one day doesn't make a trend, but the ECB came out with the full 0.5%. That was talks. They were lately they'd kind of tempered that down. They probably wouldn't do a full 0.5%, but they did it. 50 basis point hike. Yet you would think normally that the euro would explode on that and move sharply higher. So far, if anything, they've sold it. They sold it down. Remember, that was just this morning right here, right before the 9:15 announcement. And again, that's not good. If this goes down, if we break this support, this is why I'm covering this now, which I think there's a decent chance that is going to be bearish for gold and silver. So as I told you, I was in and out long and short gold and silver a couple times yesterday and through today, but that's all I'm treating it right now. More, I'm back into active trading mode more than position trading. I told you I closed out my GDX. Was it yesterday? Yes, yesterday. And then gold and silver, of course, the euro's not going up, so that's not helping gold and silver. And they were at gold's at that same level. I had a short trade there yesterday. Told you covered it there. Bounce trade, said it should bounce with the euro, gold and silver should, and they did, and they bounced right back into resistance. So that's where, as I told you this morning, I exited right there. And you also have negative divergence as well. So that's GC, that's the gold hourly chart, and then silver is SI. And of course, I'm going to let you know if anything changes in my views, but right now I am not as hot as I was recently on the metals after after we got back in following the correction, the divergent low and everything. We milked it. We milked almost all the run up, and then almost all the correction, and then just about all that leg up. But that puts me back in active trading mode. And you can see the levels. We've got some support here. They'll probably step in and buy. But again, we just put in. Let me draw it here. It's not. I had the divergence line there, negative divergence. So That and the fact that the euro is not rallying on a 50 basis point hike, I think the consensus now is the Fed is going to do a quarter point. As of yesterday, I think the odds were kind of split between a Fed doing nothing and then doing a quarter point. Remember, just a week ago, it was strongly favored they do a 0.5%. As soon as the Silicon Valley Bank thing happened, I said that's going to wipe out 50%. That's off the board, and then it went down to 25, now 0. Now I think, but the fact that ECB did 50 is going to force the Fed's hand to do 25. That's my guess. I think 25 will be locked in. Of course, anything other than that, or even that, may rattle the markets. We'll see. We'll see what happens next week. Oh yeah, back to the markets. I gave you that setup today, this morning, and here it is. This is RTY, these small caps. Remember the regional banks. A lot of the regionals are in the Russell 2000. You have really nice support there at 1745. That was this whole trading range right here, right? We consolidate. I always talk about these trading ranges like building energy like a coiled spring. You had a breakout, a perfect back test. That's technical analysis 101. That's textbook stuff right there. And then you rallied. You came back down to it. You had a little bit of reaction on the top, but it's still, you can see that top of that range, about 1811, 1812, is still resistance. So we're back in there. We've had a couple spikes down below, but we had this positive divergence. And as I said this morning, if you break out and then especially above that 1812, it's probably going to open the door for a sharper move up. I can give you one other level if you're going to trade the small caps, but if they don't, this is my experience, and this is bear market stuff. I only see this in bear markets. When you see a beautiful textbook looking bullish falling wedge pattern, which is exactly what that is, all the better. One of my favorite patterns to trade, and all the better when you're at support as well. Should that fail to play out, meaning you either break out and then crap out, or just you don't even break out, you go down, very, very bearish in my opinion, when a textbook looking bullish pattern that should play out doesn't play out. And that usually happens, as I said, in bear markets. So I'm watching that one. Even if it breaks out, that should carry us up a lot higher, or should. I don't know if it will. I'll take it day by day, minute by minute. Like I said, if you are short, you have to respect that. We're pushing right on the trend line now. Tech's holding up. If tech doesn't roll over soon, and the S&P will probably break out. So let me just, on that, let me cover the S&P as well via ES. There's the S&P 500. This is a 60-minute chart. There's your primary uptrend line off the mid-December lows. We are still below that. You also have price resistance there. Remember, we have the resistance on the daily chart. I will say we just took out this trend line right there. You can see we had nice clean 1, 2, 3, 4, 5 reactions and a breakout. But then, we all see what we want to see, and I'll recognize that. That's a breakout. Got to give points. But the bigger resistance, more significant than that trend line, which only has about maybe 4 or 5 reactions. Let me tighten it up a little bit. It's bothering me the way it is. Comes in. I have to move it here. Okay, here what I was trying to do is connect it to 1, 2, 3, 4, all these points. So you have enough reactions. However, you have significant price and trendline resistance just above. So what I think this will probably serve to be is a suck-in move for longs and suck some shorts out. And like I said, me personally, I'm giving it some room, and we'll see what happens by tomorrow. My guess is, I don't know about you, but if I was, let's say I was very bullish right now, I wouldn't want to go home very long on Friday with last weekend we had 2 banks fail, between Friday and Sunday, and get taken over by the FDIC. So yeah, they've shored them up, but then there's another one they halted today, and you can look at that. Like I said, just track KRE. Let me go to the daily chart. Just type in KRE to watch the regional banking sector. sort by gainers and losers, and you can see that First Republic down 26. I think they halted it today. It's trading now down 27%. Okay, so they came in and supposedly short up the banking sector. Then what's First Republic doing trading at $22, $23 when at the start of the end of the last bull market, start of the bear market, this was a $220 stock. So that thing got cut down tenfold right there. And it's just falling off a cliff. So that tells you there's still something wrong. Pac West down another 13. We're not out of the woods yet, is what I'm trying to say, folks. Maybe we are, and we'll only know it in hindsight, but according to the charts, we are not. So those are the things I'm watching. I gave you a trade idea on natural gas last week. We're back to where we broke out. That's NG, natural gas 60-minute chart. We had there's a falling wedge right here. There was a support zone, lots of reactions along this support zone that runs down from there. We had 2 spikes down. I think it was highlighted right about here on this breakout, maybe above this trend line. We're right about where we started. It hasn't gone anywhere, but I know I have a lot of lines here, but let me show you what we need to do is this line right here. And this one, this forms a divergent low. We have a double bottom low with positive divergence. So if we can pop that, it should run, and the measured target would probably take us up here to that 835 target there. So that's natural gas. I already threw out coffee for you today. You can use, the the futures KC, or you can use JO. Playing this one like a fiddle lately. Getting out there. We had right into resistance at about 55 target with a bearish rising wedge. Shorted, pulled it back to that 49.50, and back in. And I think this will continue on up. And then somebody asked recently about wheat. I haven't done a lot of updates. Wheat just couldn't get going. It kept having these divergent lows. It kept rallying off them and then just making a new low. But I'll tell you, the divergence gotten larger and larger. And again, I believe we are in a larger early stage of a new inflationary environment with rising rates. But nothing goes up forever. Wheat had more of a blow off top with the whole Ukraine invasion thing last year, and it got ahead of itself. And that tends to give you a sharper correction when anything goes parabolic. I've never seen a security go parabolic and it end well. So you usually get that, and I think this is an overshoot to the downside. But again, all I can tell you definitively is we have that divergence continues to build. We have a bullish crossover pending. Last time we had a low level bullish crossover was right there, and it did rally, but not too much. It's got to really get up there and take out that $8 level. But again, this is all about diversification. So this one hasn't panned out the last few shots. But if you're looking for a safer place to put your money right now, wheat oversold here. You can see again, last time it was this oversold was right there, and then we put in a divergent low, and you can see it rallied quite a bit from there. So these are the things, in my opinion, have a much better risk reward ratio. They also don't have a correlation to the stock market, and they also don't have the risk like some financial institutions do right now. So I think it's time to continue to nibble or start nibbling on some of these ag commodities. Oh yeah, and I'm going to wrap up here. I'm going to loop back to one thing, not to beat a dead horse. I want to show you one thing that I noticed the other day on the SPY, the S&P 500. So let's look at this. So there are a couple ways on the weekly chart here. I'm going to turn off all the other lines to use the PPO as a trend indicator. And one of those is whether it is above or below its zero line. So down here you have the PPO, you have that dotted line in the middle, that's the zero line. And when the 9 EMA, because that's the last of the two to cross, that's why I use it, when it's below the zero line, the trend is bearish. That goes back to 2015, 2016. That was you can either call it a bear or a deer market. You had two drops in excess of 15%, but those spanned, it was about, basically, the market went nowhere for about a year and a half, and it was mostly down. It would have been a great time to get out. And the big corrections were in there, and that told you, get out of the market. The only other times that we've had in recent years, that fourth quarter drop in 2018, which was the biggest drop, many indexes either fell close to or over 20%, so technically bear markets, and a lot of them by the 20% metric. COVID, 36% drop in the S&P, and now. And all I can tell you is that line, once you cross below it, often acts as resistance. Once you get back above it, great, you're back in a bull trend. But right now we are back testing it. Not only are we back testing, but the PPO is rolling over, poised to make a bearish crossover, which means we would get a rejection there. And then the other thing which is related to that is the histogram, and the histogram tells you when these lines cross, and so that would be right here. So if they cross and it looks that way, the momentum's headed down. Unless we start to rally strong from here, you can bounce. Sometimes that happens, you look like you're going to cross, or you get one little whipsaw and the trend resumes. However, I like to look at these crossovers and what I call big green hills. You know, you had a big green hill here, right? You had a few crossovers. You had a cross there, finally another green, and there was the cross. That was the start of the bear market. So you can see, again, most of these red hills are during bear trends, and the green hills are during bullish trends. Even these are the bear market rallies. And you can go back to the previous bear market. That's what I like to do. You don't want to compare it in a bull market. If we're still in a bear market right now, which I believe we are, let me drag this over here. I've got to move the dates. Okay, there it is. So I've zoomed in. This is 2007. That was the end of the last real bull market, in my opinion, in the last real bear market from October 2007 to March of 2009. And you can see that you had a crossover right there, right at the top, bearish crossover. You had one big bear market rally early on that where the histogram went green, and the rest of the time you stayed red. Or when you cross back red, that's when you wanted to get out of your longs. That's when the next downtrend began. So pretty effective, and you can replicate it yourself. I sit here and go through each and every one. It'll take forever. You know, pull it up on your own chart, put up the histogram. And the other part again is look at the lines. They cross right here, the PPO. That whole time it stayed below. That right there, if I take this box up, let me do it that way. If you're using that one metric, it will tell you to get out of your longs and be short throughout that period. And you would have either sidestepped the majority of the bear market or profited from the majority on the way down. Okay, and then the same thing right here. The previous one, there was a dot-com bubble. March of 2000 was the exact high, and this is when the histogram, that white line, was below zero. Pretty darn effective indicator. Okay, so that was then, this is now. So like I said, they're running it up today. Algos, high frequency trading, will step in and buy. When the market's going up, you got a lot of short covering or a lot of nervousness lately, so they're going to buy this market up today. At some point, I give you resistance levels to watch. It should cap it. And then again, depending on your time frame, you know, if you're a very active trader and you've got a very large position, you might need to more aggressively manage your stops if you're short. If you're a swinger trend trader, a lot of these trend indicators, including but not limited to the you know, the long-term trend indicators, the 200-day moving average, which here is a 40-week moving average or below, on the monthly chart. I like to use that 20-period monthly exponential moving average, and we're still below that as well. So and of course the histogram works very well on the monthly as well, and it's saying you're still solidly in bear territory right now on the histogram on the monthly chart. You know, green is bullish, bull trend, red is bearish. This was the last bear market back in 2007 to 2009, and if you followed again on the monthly here, it told you, hey, be out of the market or on your longs or get in short. And there was a previous bear market right there, 51% drop, and got you out really right on time. And then the entire bull market right there, other than a little tiny whipsaw, was captured with the positive histogram. Most of the bull market here, and again, it sidestepped, got you out of the corrections, and got you long during that. So that's it. So that's bigger picture stuff. And again, your positioning If you're heavily short, because I've been saying for weeks now, that's not that all-in moment yet. That all-in moment will come. It's incremental, as I said before, but lately I've been focusing on these lows from Monday. You got to take out Monday's lows. That will then solidify, I think, this failure back below the downtrend lines. That would be certainly a point to add on to some swing and trend shorts. And then when the Nasdaq rolls over, and again, the Nasdaq moves fast, and so if you see the financial or the S&P, everything else roll over and start to do this, at that point, I suspect the Nasdaq will outperform and play a very violent game of catch up to the downside. Again, if there's big ifs, these are all ifs. We can go this way too, so respect whichever way we go. I'm going to wrap it up here and continue to hunt for individual stock trade ideas, because until we get out of this back and forth grind, that's kind of bigger picture. Been up down. When you turn off all the lines. These were nice trend, easy to trade trends. We were pretty much on the right side of most, if not all of those, even these. But this, now you can see we're sort of moving around in a larger sideways trend, and so we're at the lower end of that trend. But like I said, you have to decide what are you focusing on, what is your time frame. And if you're swing and trend trading, to me, I'd still maintain, as long as we're under there, I want to be short. We start to get back above those 200-day moving averages, first the simple, then the exponential, above the trend lines, above the near-term downtrend lines, everything like that. There's your, well, it's not going to be there. Oh, I already had one there. I was trying to redraw it. My lines repopulated. That's what starts to change things for me when we start to move up there. I'm going to wrap it up here, and before I do, I can see Intel coming up on that second target now. For those of you that didn't put profits there, that's where I took profits, so I wish I would have stayed in it, but that's fine. We're coming up on that second final target I gave you right there, about 30.50, so maybe a heads up to start either tighten up stops or get ready to book some profits, because I would put very, very good odds on a reaction there, meaning a tradable pullback or at least some consolidation at minimum. You've got the 200-day moving averages, you've got massive price resistance, big W type bottom there. Longer term, I may revisit it as a bullish setup if we break out there, but I don't think we're going to go from here to there and right through there. So I just want to point that out for those of you in that one. Oh, and I keep talking because somebody asked today on NVDA. AMD they didn't have a good read. These are the two of the biggest semis. The NVIDIA is still right around that 240 resistance level, but most importantly, the bearish rising wedge, it broke down. It's still back testing the wedge from below. So you had a breakdown, back test. The negative divergences are still intact now. We just need to roll over. You need to see it roll over and start moving away from the trend line, especially with an impulsive red candle or multiple candles. That will help. AMD, I said I gave it some points. It popped that 88.66 resistance. That was a resistance level, previous reaction high. So you got to give it some points. But the fact that it has this divergence, what I said in my reply, and I put a chart up, at most I see it carrying up here. There's next resistance about 90. Call it about $100. It's not a hard line. But being the fact we have this negative divergence, I wouldn't be surprised to see that breakout fail anytime, because breakouts that occur with negative divergence have a much higher rate of failure. So that's how it looks. Now, bigger picture, like the NASDAQ 100, you do have this one taken out its bear market downtrend line in the 200s. So you can't get uber bullish, but if we fall back, it will be a while. If we fall back below the 200s, come back in, you have your primary uptrend line and then the downtrend line here. And then longer term, I still see these the semis going a lot lower. I still have lower targets on not necessarily AMD. That's not been one of my favorites for the short side. It's NVIDIA has, but again, we already hit, let me pin that. We already hit that second target right there and reverse right off that. But I still maintain these potential longer term targets. We just need to roll over first. So there's the update there. Watch really it all goes together. If the semis are going to roll over, the Nasdaq's going to need to roll over. If it's going to roll over, it's going to do it, I believe, this week, is in between now and close tomorrow, start to move down, or next week. If it doesn't, I'll tell you, that's you have the levels to watch ahead, overhead, but yeah, I really think the time is near where it needs to roll over and start to play catch up to the downside to the small caps and the S&P 500. Okay, I will wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.